really,
Happy New Year.
yeah, it's really almost 2024.
Yes, Happy New Year from the Shreveport office of Eagle Financial, a wealth care company, for the latest and final 2023 edition of the Jack and Bill Show, live from the fifth floor of the Beck Building in downtown Shreveport. You know, Bill, I was waiting for Westley to reinstall something on my computer so we could do this today. We were trying to make my computer speed up, and I'm reading some of the biggest stories of the year. I'm reading here: the year college football ate itself. Jimbo Fisher did so much with all this NIL stuff. Wesley,
I thought this was the Jack and Bill Show.
what's wrong?
Oh, you're making it a sports show.
Oh, no, we're just starting off with sports.
Okay.
This is what I was pondering. You know, there are first round potential draftees that are coming back for a final year of college football because they can make more money playing college football due to this thing called NIL. Do you know what NIL is, Wesley?
Neuro Intelligence Leading System.
No, sir. It's name, image, and likeness. And it made me wonder, you know, now that we're part of wealth care, if we're being adequately compensated, Bill, for our names, images, and likenesses.
I worry about other things.
You're worried about other things?
Yes.
Like what?
Not that.
It was a joke.
Boo. Bad joke.
So, yes, we have Clemson and Kentucky underway, by the way, as well as Notre Dame and Oregon State. And then I'm very interested in, speaking of this, before we move on, the Missouri-Ohio State game tonight. And I have to say, I'm rooting for Missouri. They're in the top 10 this year. They had a fabulous season. They did get whipped by LSU late in the fourth quarter, but I've heard that Ohio State has had a lot of key players, including their quarterback, enter into the transfer portal. And so,
is that like the thing from Star Trek?
yes, they get transported to another college and university to make much more money than they would have made had they stayed home. So, but anyway,
And this is why people are giving up on college football.
yeah, I totally agree.
The bowl games are worthless.
I would,
unless you're in the playoffs. You're not watching the same teams that competed in the regular season.
well, even Bill, I'm on a 11 o'clock flight tomorrow to go to Tampa to watch. My wife Stacy's obviously a diehard Saints fan, and we could stay at Raymond James Stadium an extra day to watch LSU, but LSU is playing 7-5 Wisconsin, which I don't know what the name of this bowl is. I would call it the toilet bowl. But Jaden Daniels, the Heisman winner, is not playing in the football game. And I kind of have a problem with that, too. I think that when these guys are recruited, athletic directors and coaches should make them play in the bowl games. That's just my stinking opinion. But that's part of our sports year-end review. Now on to finance.
Now we're gonna have even less.
Finally.
Finally.
I think we lost our viewer.
So what was the biggest story of the year, do you think, Bill?
In the economy, the markets?
Yeah.
I would say the biggest story of the year, you could say, is the resilience of both the economy and the markets. In 2022, the economists, the consensus as we approached the year end, they were predicting a recession this year. That did not happen. There was a lot of concern, that would bring volatility to the equity markets. And we saw the equity markets take off the first of the year, led by the Magnificent Seven mega cap tech companies. And the last few months, we've been seeing a broadening in breadth of the market as the rest of the market's picking up. So I'd say, again, it's that word resiliency.
Yeah, and I mean, and you're exactly right. I was looking at one of our holdings. Well, we own a large cap Russell 1000 play, cows, cash cows, COWZ, and they have a smaller version. Obviously, it's the symbol is calf, CALF, and it's up something like 33% this year. So the Russell 2000 finished up really strong. But just to give our viewers kind of a sense, and y'all probably understand all this, the Dow Jones Industrials through yesterday is up over 13%. The total stock market up about 24%. We own SCHB. The QQQ up. I just checked the Quotron here just a half hour ago. The Qs are up 53.6% this year, and you mentioned that the Magnificent Seven, comprising I think in the NASDAQ 100, the market caps are about 60% of the NASDAQ 100. And then value stocks, I looked at Vanguard VTV, it's up 6% this year. So gold was up about 13%. Silver kind of flat on the year. Interestingly, the biggest winner of anything that I know of was in the crypto space. Two of the Grayscale funds, Grayscale Bitcoin Trust is up 317% year to date, and Ethereum is up 309. And then the Magnificent Seven, as you mentioned, Bill, they're up on average 75%, led by Meta up 194, Nvidia 241%, Tesla up 103. Let's see.
All of this is available on Google.
But this is where perspective is very important, because when we talk about these great returns in certain sectors, especially technology, and then you mentioned crypto, if you go back over the last 2 years, 2022 and year to date 2023, the markets are basically flat.
Yeah.
So the S&P 500 over 2 years is flat. The Qs are barely positive, even with the strong gains. The cryptos, with the gains they've had this year, are still down from their all-time highs. So if someone is trying to just ride the indexes, they've been experiencing a lot of volatility in the last few years, and that's why we endeavor to really generate reasonable returns without all the undue risk. And we put a lot of emphasis on real diversification, because we never know. We cannot predict year in and year out what's going to be the best performer. It just so happened to be, the Qs of the major stock indices and these big tech companies.
And the Qs are pretty much have just barely gotten back to where they were, as you mentioned.
Absolutely.
The Dow Jones has made, I think yesterday it made its 7th new high this year, and all 7 of the new highs, I think, were really here in the last month. So the S&P 500, if the S&P 500 had a big blowout up day today, it would make a new high, but it has not gotten back to where it was.
It's still down.
So, and you might throw this out. So as you were quick to point out, you could say, when the internet came about and all this, we had new economy stocks, and I was just pondering this today, old economy stocks. So in the new economy, or tech, AI, crypto, Mag 7, old economy, those were the winners this year. The laggards this year: oil, value, autos, financials, healthcare, REITs, things like that.
NFTs. Remember NFTs, non-fungible tokens?
Yeah.
What happened to them? They're gone.
Yeah.
NFTs have lost almost all of their value.
Yeah. So then in other areas, managed futures turned out to be, coming into the year, that looked like a great place to have some diversification. And then we got whipsawed so badly in February, March, then again November, and even again now. And a lot of this and the year-end rally that we've seen, it's just been on fire for 6 weeks. And prior to this 6 weeks, all the talking heads were saying, you need to get ready for this ugliness and more downside. And then, you could have banked on the opposite of that. So we saw these markets take off with basically the biggest determinant of this, in my view, was a rapid shift that came from Jerome Powell's mouth and then to expectations of what interest rates are going to do. We saw the 30-year Treasury bond yield go from 5.1 to under 4. It's come back up over 4 today. But Bill, as you mentioned this, so we talk about the bond market. The bond market and interest rates really most of the time drives the stock market. I'm looking at today's Wall Street Journal. If you bought long dated treasuries 36 months ago, if you put $100,000 in that, you would have 88,000 and change today. If you bought the Bloomberg Aggregate Index, which has a duration of about 6, that means if interest rates go up 1%, your principal declines 6% and vice versa. So that's thought of as a low volatility index, which most bonds and bond funds are indexed off of the Barclays Aggregate.
Well, the Barclays,
Bloomberg Aggregate.
The Barclays Ag has not recovered. It is still down considerably. Now, we said earlier that the U.S. stock markets have basically recovered what they lost in 2022. The Barclays Ag has not.
Okay, if you bought it 36 months ago, you put $100,000 into it, you would have $96,750
and if the Fed,
and that's safe money.
Yeah, and if the Fed does follow through with rate cuts next year, ag might be a good place to be. Just saying.
Well, it's been a really good place to be in the last 6 weeks. And in spite of that, one more month of this, and we would likely see it creep back into positive territory. And our clients who own bonds have greatly benefited from owning credit, shorter duration type stuff. Our largest bond market position is going to wind up making about 7% this year. And that's kind of where intermediate term bonds are this year. But to get there, some of our clients could have easily been whipsawed and scared out of that. And not so, with the funds that we've owned that really don't fluctuate a whole lot. So BDCs, these are bank style loans. These are still a wonderful place to be and have been for the last, year and a half with all the Fed tightenings. I think that's still a wonderful place to remain. So really, as we look forward, we just kind of recapped the things that did well last year, the things that did poorly. What do you think about 2024, William? Do you think we're going to have a replay of the same?
No, I don't. Because we had such extremes in 2022, and then we had a reversal in 2023, and it was a sector reversal too, style reversal. No, I think that the momentum can continue into the new year. The hype surrounding the AI themed tech stocks can continue for some time. We talk about how the markets are discounting mechanisms. So prices are reflecting the past, the present, and then a reasonable expectation of the future. And so if I fully expect to see that the discounting will take into account the rate cuts and these long duration investments, long dated bonds, tech stocks and things like that. I think that they're going to start to fizzle out, and the rally can continue to broaden with real companies benefiting from declines in interest rates.
Yeah, I think that's good. I'm looking. We use this market perspectives, which comes out quarterly at Vanguard, and this one was dated August the 17th, and their projected returns for U.S. growth stocks. They're projecting for the next 7 to 10 years, 1 to 3%.
That's a lot lower than year-to-date returns.
Yeah, I mean, so I would say, tell me about it. So,
well, and what happens, and this happens all the time. It's investor psychology. People get excited about the things that have done the best, and you pointed out that those things that have done the best this year, and then people pile in at the top, and then they get hurt.
Exactly.
And as the saying goes in hockey, you skate not to where the puck is, but where the puck is going.
That's what we attempt to do, and that's the thing. If you get your brokerage, your Schwab statement in our case, and you open it up and you just had, it looks poor year to date or from the prior month. It's a gut wrenching thing to do, but that's the time to add money to positions. And when everyone on TV is telling you that the sky is falling 6 weeks ago, it would have been very difficult for a lot of people to throw more capital, into their accounts, and that would have been, really ideal. So with 2024, we're faced with high valuations. That means long-term lower projected returns. And then I think one of the things I like to talk about, I think the biggest story is going to be the perception of what the Fed is doing or is going to do. And then, so where would you say the consensus is right now, Bill?
Well, I mean, we can look, at a Bloomberg terminal and see the consensus, but the consensus is rate cuts by the Fed, likely 3 in the coming year. I mean, we'll see. The Fed has stated that they're data dependent, and so we need to see the inflation numbers continue to come down. The trend is down, and it needs to continue to go down.
Right. And one thing that I would point out is if you're taking a contrarian approach long term, you're generally going to get better results. But it does require, that you're right as well. But most often, consensuses are almost never correct. So what is wrong, with this consensus? And that's the thing about discounting. I think that the bond market has very rapidly discounted. When you go from a 5.1% long bond to 3.95 in 6 weeks, I mean, that's a major discounting that's underway. I think.
Well, look at the rate of acceleration in those rates that we had before.
Yeah, that's true. So I would say, and that's the problem too. I was talking to someone I had a client on the phone today, and they had some treasuries come due, and I've kind of, with this client, I've kind of rolled this out, and I've got kind of like a ladder going, and they point out that, well, the local credit union here in Baton Rouge is paying 5.6% on a 30-month CD. I mean, I think that's a pretty doggone good investment.
Yeah, that's a good investment.
So, I mean, that was actually, I don't mind confessing this. That's actually better than anything that I could show this client, but we've got a plan in place. And the thing with that, I like 3 or 4 year securities. We talked about this on the phone. The highest yielding treasuries are only 90 days out. So a lot of people would be inclined to put most of their money right there and get 5.37% or whatever it is. But what's going to happen if the Fed eases in March, and again in May, and again,
then you're rolling into lower and lower yielding securities.
Yeah, exactly. So, you can buy, in fact, even tying up, looking at that, tying up your money for 5 years in a treasury, I think the yield is only something like uh, you know, 4.6% or lower. And you don't have to go much farther out to be down into a three handle. But that could be really terrific,
Well, and
especially.
that's why, I raised the question about ag, because ag has underperformed. It's got a duration of about 6. And the time to start extending duration in a bond portfolio is in anticipation of rates declining. Because, as you say, you're going to get stuck in this cycle of lower and lower rates, and you're just rolling into lower and lower returns. And so you want to start diversifying. We wouldn't advocate long dated bonds because no, it's not worth it. You're not being compensated.
Exactly.
But extending duration, some makes sense here.
Yes. And that's one of the things, if you have a ladder in place, when you have something come due, you're going to roll it out to the longest end, but you're really not extending duration.
Correct.
You're keeping duration the same. And I think one of the biggest things that we share, like in our seminar series that we're doing, is the importance of being diversified. Because if you would have asked us to predict a year ago what things would have done the best this year,
We would have been wrong.
we would have been wrong on most things. But I would say, you look to those things that have done terrific. And I agree with you. The Mag 7 could keep going because, first off, most of those names have just gotten back to where they were. And that trend is really kind of still in place.
Well, the thing that they have going for them, they're quality names. These are quality companies with ironside balance sheets. They've got a ton of cash. The problem is you're just paying a lot. You're paying very high multiples for these companies. So they're great companies. It's just a question of, are you paying too much to own them? And we're finding companies that are very high quality in a different way, like these high cash flow generating companies that are not necessarily in the tech sector.
Performing companies,
yes.
Like Cal's that we mentioned. Those are the top 10% performing companies in the Russell 1000 large cap index. It's basically free cash flow to enterprise value. So these are the companies that are performing the best. And we can apply that to smaller and medium-sized names and international names and global names and things like that. So, but I say for next year, we continue to like short to intermediate term fixed income, definitely not long dated fixed income, especially given the move in interest rates here. And I've got to say, I really like value names, that which has lagged in the last year. I especially like dividends. There's this concept of the dividend aristocrats, and an aristocrat is a company, a high quality, one of the best performing companies in America. If you make the S&P 500, you're one of the top 500 publicly traded companies in America. But how about those that have increased their dividend for 25 years in a row? There's actually 67 of those. And in aggregate, they lagged all this AI-driven QQQ, hype and so forth. And the average dividend of the aristocrats now is, if it's not 3%, it's approaching that, very close to that, which is really relatively high by historical standards. And so I like some of these things that I termed earlier, old economy. I mean, even well-known, cyclical names in autos and airlines, for example. You can find companies out there trading at 5 times earnings, where the Mag 7 is trading at 50 times earnings. So 1/10 of the valuation of those.
Well, and to be fair, they're in different industries, and so their earnings multiples will be different because of the industries that they represent. But here's a way of thinking about it. when you have a value orientation when it comes to investing, you're buying something today where you're already, when you buy it, you're generating a return now because you're buying something at a discount to what it's worth based on your estimates. So you already have a gain, right? That's one way of thinking about it. When you buy an Nvidia, an Amazon, a Microsoft, etc., Google, these things are priced for perfection and they're expensive. So you're already paying too much for it. And these companies have to continue to deliver and generate the same or higher earnings going forward, and or the multiple, meaning what people are willing to pay for that earning stream, has to go higher for your investment to make money. That's a lot to ask. So that's the danger of buying this stuff right now, because if it doesn't work out, then you can see a rapid decline in price.
Yeah, and can these enormous companies continue to grow at those rates?
I mean, it's like the Nifty 50 names in the early 1970s. Like IBM was one. Remember some of the others? Was Pepsi one of those?
Philip Morris.
I mean, the Nifty 50 was the place to go, and they were priced for perfection. And boom.
Yeah,
we could see the same with the Magnificent Seven.
Yeah, that's exactly right. I think that, you have to have some exposure to what we call core and satellite.
Yep.
And
but how about growth at a reasonable price?
Yeah, we're going to make educated bets on the things that we think deliver the most value, and as we shoot for reasonable returns without undue risk. And the way we construct portfolios, our portfolios are going to have a way lower standard deviation or volatility than
I mean, we want to construct portfolios that are more durable, that can
exactly.
weather
that you're not going to get
volatile
spooked
markets
out
better.
of.
Yes.
Yeah, so that's really it would be a great time for any of our viewers to, if you're looking over your portfolio and you have some questions about any of your holdings, give us a phone call, come in and see us, send us an email, call us, and we'd love to sit down with you and tell you whether we love your portfolio or not, or what we might do differently. And
Is that the dinner bell?
what's going on?
I don't know. I kind of zoned out, took a nap.
Oh, well, it is sadly Wesley's last day with Eagle Financial, as he is moving far from here to the great metropolis of Phoenix.
A greater bird.
Well, Wesley, come over here and sit down and say goodbye to our audience.
No, you can stay right there.
Huh?
Let's give people a real picture of how life really is around here.
Oh no.
So these are the things that I have against you. Yeah. It's
Do you want me to come back when you're done, Wes?
Oh, it stopped. That's weird.
It stopped.
I don't know. It made a noise. But it's been a pleasure being here. Being at Eagle Financial has afforded me opportunities that I didn't think I'd ever have, like more gray hair and going bald. But it caused me to blend in with these guys.
True.
But it's been a pleasure serving most of the ones that I've met, been able to talk to as far as clients and everything. And those I never talked to. It was great serving you too. But you were easy to please. And it's actually been a great opportunity to be here, but I must go on to a bigger bird, one that will rise from the ashes. But anyhow, I hope you guys have a great New Year. Hope you had a Merry Christmas. If you enjoyed the coffee, that's because of me. If you didn't enjoy the coffee, that's also because of me. But that's okay. We enjoyed it.
Can you leave us with a goodbye Eagle sound?
Just remember, I'm not a financial advisor.
Okay. Peace.
See you next
out.
year.
Happy New Year.